So what's all the hullabaloo about the emerging markets? The financial media is all over this story, covering it to a fare thee well. And the simple reason is the returns have been spectacular. Off the March lows in 2009, these markets are up 55 or 60%. In some countries, they're up even more than that. But there's a deeper reason to like these markets. They've got strong economies, good banking sectors, good regulatory oversight, improving private sector performance as well. So there are a lot of reasons to take a stronger and harder look at the emerging markets and the underlying story there. So what countries make up the emerging market index? There are 21 countries in the index, but they're not all of equal weight. The largest 6 represent nearly 65% of the weight of the index. And 4, Brazil, Russia, India, and China, what they call the BRIC countries, make up nearly 40% of the index weight. Smaller countries like Morocco, Pakistan, and Argentina are fractions of 1% of this index. Let's turn our attention to the economies of these emerging markets. The total world economies produce goods and services worth a value of about $70 trillion. The emerging market countries account for 37%, the largest regional share. So an amazing percentage of the total of the $70 trillion world economy. The United States, for example, is 21% of that share. And our share is down from 24%, and the emerging market share is up from 31 to 37% over the last 10 years. So you can see these economies have been performing quite well. Let's take a minute and dig a little deeper into the emerging market economies rather than just the macro perspective on their gross domestic product. Let's take a look, for example, at the rate of economic growth. Over the last 10 years, the emerging market countries have compounded their economic growth rate at over 8% a year. In the U.S., our 10-year compound growth rate has been just over 4% a year. So you can see the significant variance there in favor of the emerging market economies. The second thing is that these are not trivial economies. The U.S. is the world's single largest economy at about $13 trillion, but 6 of these economies, the 6 largest, are over $1 trillion in size, a level the United States did not reach until the early 1970s. And China's economy is north of $7 trillion. If we turn for a minute and look at budget surpluses or deficits, in 2007, the 6 largest countries all ran budget surpluses. The U.S. ran a deficit. And if you look at government bonds that are issued by these countries, they're all rated investment grade. None holds the vaulted AAA rating that the U.S. government has, but nonetheless, they're all above investment grade by the rating agencies that rate these countries around the world. One area where the emerging markets really don't have the lion's share, unlike the economic representation they have, is their stock market representation. The emerging markets, instead of representing 35 or 40% of the world's stock market capital like they do in terms of their economic production, on the world stock market stage, the emerging markets are only about 10 to 12% of the world stock market capitalization. So there's plenty of room to expand there for the emerging markets and the stock markets associated with those countries. Let's take a minute and move from the broader economic picture and come over and talk about the consumer picture for a moment, because they play a critical role in all of these countries, and consumption is very important across the world and certainly within the United States and the emerging markets. In the United States, the consumer represents about 70% of our gross domestic product. So it's a very substantial percentage of our economy in the United States. That's not true when we look at the emerging markets. They range from consumption levels of about 35% of GDP at the low end to 60% at the high end. So the consumer plays a more modest role. There is a shift starting to occur there, but nonetheless, consumption levels well below the United States. Offsetting that, in the United States, our savings rate is relatively modest at 4 or 5%, but the savings rate in the emerging markets approaches 25, 30, even 35% depending on the country. So there's a big difference in both consumption levels and savings levels. And lastly, demographically for the consumer, the major age group for purchases are the age group between 40 and 50 years of age. Prime consumption years for housing, for education, all of those major expenditures. The United States population, ages 40 to 49, is expected to contract by 4% over the next 6 years, whereas it's expected to increase dramatically in several of the emerging market countries. That gives some real tailwind to those economies in terms of consumption in those selected emerging markets with those characteristics. Let's turn our focus now for a moment to the corporate side of the equation in the emerging markets, and particularly let's take a second and address and talk a little bit about their profitability. The emerging market countries and their corporate level of future profit growth for the year 2010 is projected to be close to 20%, a very attractive growth rate in corporate profits. The interesting thing about that is that in addition, the price you pay per dollar of profits in the emerging market countries is actually cheaper than the price you pay in the United States for growth in profits. So you get superior profit growth in 2010 as forecasted, but you pay less for that. So that's a part of the reason why these markets continue to be attractive to investors. Now let's talk about the historical actual rates of return that these countries have generated over time. If you go back and look at a 10-year compound rate of return from the end of September 2009, the developed world markets, like countries like Germany and the United Kingdom and Japan, have actually had just barely positive returns over 10 years. In the United States, our 10-year return, measured by our favorite benchmark, the S&P 500, has a compound rate of return that's actually just slightly negative for 10 years. But if you switch to the emerging market countries, the compound rate of return has been north of 8% compound annually for 10 years ending September 30th. And if you narrowed that gauge just a bit more and looked at Brazil, Russia, India, and China, the BRIC countries, their compound rate of return has been over 13% a year over the past 10 years. Pretty remarkable. Now, you don't get high returns without taking some high risks. And that's clearly the case in the emerging markets too. Investors just need to be aware that the risks are about 50 to 60% higher on a quantitative basis than they are in the United States over that same 10-year period of time. Okay, at this point we've built a pretty good case conceptually for the emerging markets. We've talked about their economies, we've talked about how their economies have grown, we've talked about their private sector, we've talked about their government sector, we've talked about the consumer. But how do you invest in them? How do you get there from where you are today? And most investors, particularly retail or institutional investors to some extent as well, do not have much, or in some cases don't have any investment in these markets. The three principal ways you get there would be through a mutual fund that's doing emerging market investing, through a separate account, or through an exchange-traded fund. Those would be the three principal ways to do it. You then have a second decision to make, though, and that is whether to use what we call active management versus index management. If you use index management, you're basically mirroring the returns of the index. So if China is 20% of the index, your portfolio will be 20% of the index. If Mexico is 4% of the index, your portfolio will be 4% of the index. In active management, however, a professional investment manager, be that for a separate account or a mutual fund, is making a decision to put more money or less money into China, more money or less money into individual sectors or individual securities. It's called active management. Let's take a look at the records of active management versus the index fund over the last 10 years. The active manager has actually slightly outperformed the index fund over the last 10 years. And so there's been some evidence that's accumulated over that period of time that going the active manager route does seem to have a slightly value-added proposition for it. And by the way, that's net of expenses, and that's an important thing to consider. If you use active management, the expenses are usually slightly higher. So in summary, we've got a very good case here for the emerging markets. So from our perspective, yes, there's a lot of sizzle going on around the emerging markets. The good news is there's also a lot of stake.